Welcome to TheoTrade. This is Don Kaufman. It's April 7th, 2023. It's a Friday, kind of mid-morning. It's a holiday weekend. The markets are closed. Nevertheless, we still release the employment situation this morning. Of course, that's what's on your chart directly in front of you. A little bit of a bid to the marketplace. Look, it was nothing to speak of. It was almost in line with some of the estimates, but right down to business on this weekend's update entitled The Pause Before the Storm. Obviously, a fairly quiet week in the markets. We're going to explore that in the S&Ps momentarily, but before we really get there, again, the jobs come out on a Friday where the market's closed. Curious to say the least, but as I was saying, the jobs number came out kind of as expected. The S&Ps, they loved it. But people, before I even start looking at the S&P futures and start discussing levels and the 4106, I think it's critical to bring up the Fed Fund futures and explore, if you will, well, the deep-seated confusion, if you will, of Fed Fund futures. Let me explain what's going on right now and why it's one of the first, if you will, topics of conversation, because it has become almost downright comical here of how indecisive the marketplace happens to be. So for those of you who have never seen this, this is the CME FedWatch tool. And what the FedWatch tool it takes the Fed Fund futures, which is a tradable, tangible product, and it turns it into just probabilities. If you look at current Fed funds, right? They're trading right here at 475, 500, right? That's the current rate. And then it gives you probabilities for instance, the next Fed meeting, which is the 3rd of May, right? So on May 3rd, there's going to be a Fed meeting and says, well, there's about a 33% chance of them remaining massively unchanged. And yet, here's the big one, there's a 67% probability, okay, that the Fed is actually going to raise by how much? And again, it's about a quarter point because this is 500, 525. Present is what? 475, 500. Again, we're looking at 67% probability. This is a dramatic move. Dramatic move from when? From where? The jobs number. The jobs number of the employment situation that came out this morning still showed relatively strong growth in terms of the jobs number, which, may incite the Fed to continue its raising cycle. But why am I saying it's sheer and utter chaos? Well, for this reason. It's not the May 3rd one that's got me going. You start to go out to like the 14th of June, and then the 14th of June, all right, they're still showing like, it's 475, 500. There's a 66% chance that it'll be 500, 525. So for the most part, between now and the June meeting, okay, they're still only pricing in a quarter point hike. There's a 1.7% chance of like a half a basis point hike, but you get the point. So they're basically saying by June, we're going to raise by like a quarter point. This is where things get interesting, okay? You go all the way out to the July meeting. Yeah, the July meeting is complete and utter indecision, but there's a higher probability that we're actually going to be back to 475, 500. And wait, there's more. And again, there's a reason I'm covering this. You go out to September. Oh, September is already starting to price in a decrease in rates. You go even further out, and the probability of rates being lower is larger. Again, it is chaos when it comes to the Fed Fund futures. There's no question about it, and it's one of the things that I'm telling you this summer. It just screams volatility. It's going to wreak havoc on the marketplace, and right there, okay, with no unequivocation here. Look. That's why I'm calling this weekend's update the pause before the storm. All I'm going to tell you right now is this summer, this is going to be Mr. Toad's wild ride. This is not going to be that kind of, we're going into the doldrums of summer. It's not going to be a quiet summer. There's too much geopolitical risk. You can see the Fed Fund futures, they're all over the place. So we're going to be very, very data centric. Every single data report comes out, it's going to actually spike markets, contract markets. It's going to be wild out there. And that is exactly why I wanted to start with, again, entitle this The Pause Before the Storm, but start with the Fed Fund futures. With that, let's jump right to the S&Ps. So the S&Ps, you're thinking it's a bit of a rally this week. It's not a rally this week. Let's take a look at the SPX specifically. And the reason I'm looking at the SPX, just to give you a quick feel. So the rally is, well, it didn't rally this week. So after, again, we've seen a pretty significant rally like the last 3 weeks, trading from, again, SPX here, we'll call it 38.50, trading from the 38.50 right back up to 41.05. We stalled out this week. The markets, for the most part this week, where they're going to finish massively unchanged. Please do not even read into this, right? When I say don't read into it, what you're actually looking at, and I'm zooming in as tight as I possibly can on the dailies, right? These are the dailies. So this central line that I'm about to highlight right in here, that's the starting point for like last week of trade. The starting point and the end point are basically the exact same, right? And that's critical. Now, another critical area, before I go any further into the S&Ps, another critical area in here is that most of this week, and I'm actually going to pull up a 30-day 1-hour chart. I love to use this particular kind of designation. Most of this week, though, kind of had an ebb and a flow on a very key level, and that was 41.06. And I say, long live 4106. And I'm just highlighting it across your screen because, again, from, everything from Tuesday, Wednesday, like Thursday, we saw this particular level. And it's one of the levels that we kind of called for inside of the market on last weekend's update. And of course, we were in a shortened holiday week of trade. But again, throughout the course of this week, we just we're trading right to the 4106, which leads me to believe that a lot of what you're seeing in the marketplace, and I know that everybody's like, no, we're on a wicked rally. If you take a look at the rally, though, this is again, it's a 30-day 1-hour. Yeah, I'm not arguing that the marketplace moved up. Okay, that's not, up for grabs over there. Clearly, the marketplace moved up. What we're really doing, though, is kind of pinging from gravity point to gravity point. And I think that what would better display just that, we're now going to jump to a 180-day 4-hour chart. And when you look at a 180-day 4-hour, okay, it's exemplary of, well, exactly what I'm trying to display to you. And that is when I talk about pinging from different levels, look, and we're trading down below over here. That's the 39.31. That's one of the most pivotal levels that we've seen, kind of showing it across the screen over here. I can do a much better job, obviously, of highlighting that, and I'm going to do just that. The 39.31, okay, is right here. I'm kind of boxing it in. Up top over here, that is 42.11, okay, and right smack in the middle, which is a newer gravity point. Our newest gravity point is that 41.06. And one of the things that you get very well displayed in this particular circumstance is, people get all hopped up about the rally. And again, just the reality is we're just ebbing and flowing from levels back and forth. Like we've seen this movie so many times before. And again, I don't really constitute this as a rally. Like, when would I really start calling this a rally? You get above that 42.11, like meaningfully above 42.11. You got me at that point. I'll call it a rally. But at this point in time, this is just volatility. It's volatility, waiting for another kind of shoe to drop in terms of ultimately, data and so forth. So again, one of the things you want to be aware of at this point, in the midst of the volatility, there's still an incredibly high short interest. It's like record high inside of the S&Ps. And in the near term, I actually have a very strong belief, and I want to be very clear about this. Longer term in this marketplace, throughout the course of the summer, the next couple of months of trade, I'm absolutely outright bearish. And I like to make the statement, okay, and make sure everybody hears it. I am absolutely outright bearish. Not a lot of things to get bullish about. Okay, there aren't. There's just not a lot of things to get bullish about. But I'm also extremely aware that there is just horrendous sentiment around the marketplace, and just the number of shorts that are in the marketplace can actually drive the markets higher. So in effect, I'm actually a strong believer that at times you got to go higher to be able to actually reverse lower. And this is one of those times. And what I cannot tell you is, was that the higher move? Like, have we actually hit it? Because, when I sit here and I point out, like, I'm bearish, okay? I've been bearish. I've been bearish for a while. I was bearish all of last year. It's getting old at this point, okay? But the point to be made over here is every time we have one of these rallies, like I try to be a little bit more the voice of reason. You're like, is it a huge rally? Yeah, just like this rally. Oh, yeah, just like this rally. Oh, yeah, just like this rally. Oh, yeah, just like this rally. They're all huge, okay? They were all wonderful, right? Until the point you got dropped off into your under your head, and everybody goes, well, but this one's different. And I reiterated this just a few weeks ago. I was like, oh yeah, this one's different at the beginning of the year. Okay, what's different about it? It's smaller than the previous one. It's smaller than the previous one. Look, the rally that we've had thus far is actually very, very minute. Okay, and this rally, as what I'm going to point out here momentarily, may have already come to an end. Why? Start to look at sectors and their expected moves. So we've talked about a little bit about 4106, and when we're pinging back and forth between levels, it's not so much a rally as it just is short-term volatility, right? That's it. Like I look at this marketplace, again, you're like, it's a rally. No, I look at it as short-term volatility. That short-term volatility took us up here before, took us all the way to the 4211, dropped us back down. We got all the way back down to the 3800. We rallied back up to the 4106. Like it is what it is. Look, it's again kind of ebbing and flowing in this marketplace. That's just some volatility. As long as you're selling premium in here, you're gold, Jerry, you're gold. Even if we were to rally up a bit more, it's not really going to impede upon us a tremendous amount, those that are premium sellers. Now, I question, okay, again, there's a huge amount of short interest. We've had this explosive move up. And the reason you have to have the explosive move up when everybody's short, you have to have the shorts kind of cave in a little bit. And the big question is, when do those shorts cave in, right? Because you can get these gamma squeezes, which can last a significant amount of time. And again, I'm very often a big believer, you got to go up to go down. And that sounds so, strange, especially when I'm a bear. Okay, and I am a bear in this marketplace, but because again, there's just not a lot of good things that are about to happen here this summer. The Fed's still going to raise rates, it appears, and we're going into a recession. That's the only reason that the Fed fund futures would display actually a contraction further out in time is not only are we going into a recession, the Fed's trying to put us into a recession. And that's not a happy thing. And then we have to talk about the debt ceiling in a couple of weeks. That's going to be exciting. And geopolitical risks. Oh my! Next thing you know, ChatGPT is going to be calling you, taking over the marketplace. I love it. Anyway, let's look at some of the sectors because I question right now, maybe, just maybe, this market rally may already be over. First of all, we're going to bring up the financials. Why am I bringing up financials? Go to auto expected move. What I want you to see in auto expected move, right? The financials had recovered last week. This week, for the most part, unchanged, similar to the S&Ps. So nothing to see here in the financials, other than the fact that financials haven't really recovered all that much. Financials are also going to be going into earnings. When? Very soon. Okay, we're actually going to be facing earnings like literally the end of next week. And a lot of people aren't aware of that. But when I start looking at stuff like Citi, it's a hop, skip, and a jump off the lows. You look at like something like JP Morgan. Do you realize JP Morgan's actually butting up against its lows? Oh yeah, and it had its earnings next week, right? And then you look at like Bank of America, right up against the lows. Like this is basically, there's a big reactionary low here at 26, but it's trading 27 and change. Its earnings are coming out a little further, but there's going to be a lot of movement in the front of financials. Look at Morgan Stanley, basically at lows. Its earnings are just about 10 days out, but nevertheless, this is going to be important, people. Okay, this one, we are on deck for earnings inside of the financials, and they haven't really recovered at all. So it's part of the marketplace that's incredibly weak. But you already knew that, right? So when you know something, that's great. Okay, it's weak, it's very close to a break lower. Then you have to look at the energy sector. The energy sector got a really wild bid under it from a move of OPEC last weekend. OPEC turns around, cuts production, the energy complex rallies, but this is interesting. Even though it rallied, we actually closed on the upper edge of the expected move. Okay, that is in large part, in the energy sector alone, in large part, carried the S&Ps this week. Why? Because what I'm going to show you here is also, I think, going to be surprising. If you go to auto expected moves and we bring up the QQQ, it's tech, right? Tech, the entire week struggled at the lower edge of the expected move, got a little bit of a rally under it, okay, on Thursday. Again, there was no Friday. Today is Friday. There is no tomorrow. No, there's no Friday this week. It is Good Friday. Markets closed for the Easter holiday weekend. We'll be back open on Monday. Nevertheless, a little bit of a bid came into the Qs, but the Qs were substantially lower. And right here in the Nasdaq is why I'm actually questioning if the rally's over. Because 2 weeks ago, I talked about the next sector to get pummeled. And you better believe, I believe it is going to be tech. So, all right, we talked a little bit about 4106, the short interest, a couple of sectors in here. To hike or not to hike, it's just complete chaos when it comes to Fed fund futures. There's one other area, and I was talking about this last weekend, and I want to further it right now, what I term risk on, risk off. Go look at the bond market. The bond market right now is still literally sitting like at or near highs. Okay, the only thing I want to point out about bonds, it's chaotic out there inside of the bond market right now. It does not leave me with a warm and fuzzy feeling for the markets. I can't discern, is capital piling into the bonds because they're using a duck and cover? But then at the same time, if the bonds start to sell off again, that means rates are going higher, and it's unequivocally, rates going higher is going to hurt tech. It's going to hurt financials because we realize that there's a lot of financials that are still screaming out in pain. Okay, either direction of bonds right now could be catastrophic. This is going to be something that's going to evolve. Like, again, I don't have a great feel for bonds, but I wanted to bring them up first and foremost because, again, interest rates are about to be once again the talk of the trading community. They have come down from the 4% level, dropped precipitously to 3.288, and they could actually rip to the upside again. This is going to be, again, a very tentative situation. We're going to be watching carefully in terms of risk on, risk off. When it comes to VIX and volatility, you're like, it's the bottom of the barrel. Of course, we've rallied. But the other thing about volatility, okay, look, we've seen this level, okay, of the 4,100 variety so many times, the market's like, all right, I'm sick of it. So volatility right now, don't expect it to be rocking, but at the exact same time, when the VIX is in and around the 20 region, okay, it's still high relative to what? Relative to, umpteen years of volatility. When you start pulling up like max charts and volatility, or looking at like the last 15 or 20 years in volatility, you got to realize that 18 to 20, and again, where my line is going to be on this screen, right? And I like to draw this because, all right, we're still consistently in a rather high volatility situation, even though, like, you're looking at volatility, it's down, it's contracted. If we rally anymore, it's going to make some great opportunities for that. All right, so we looked a little bit about VIX bonds. All right, taking a look at gold. Gold right now just happens to be butting up against its absolute recent highs. And I'll tell you something about gold. This thing does look like it's going to continue to break out. We do have a bullish trade on in gold. Moving on over there from the dollar. The dollar continues to get pummeled over here. Key level is obviously going to be 100. Just stick a fork in us if we go under 100 in the dollar. Gold is going to rally huge, and it could cause some adverse effects in not only the commodity products, but specifically inside of the S&Ps as people get really nervous and are running right now from the dollar. It's going to be well worth watching. Obviously, oil, I was mentioning a moment ago, big bid under oil. I believe this is going to be a sustained bid under oil. Now, a couple of underlyings I wanted to cover here in this weekend update. First of all, Caterpillar. I maintain a short position on Caterpillar. It's been getting decimated in some recent trade. Its earnings are coming out, obviously, like everything else, in about 20 days. Nevertheless, okay, this could be opportunistic for a huge break to the downside at this particular point. It has been a bidless move inside of Caterpillar from recent highs. And again, I did not, in fact, short at recent highs. I've actually been carrying a position for a considerable period of time, just short a couple hundred shares in here in a number of different accounts. But I am outright short the stock. What I am looking for inside of Caterpillar, and the reason I'm bringing it up is, again, continued movement to the downside. Nevertheless, if I bring up auto expected moves, shattered expected move to the downside. If it shatters expected move again to the downside, it may actually moderate before earnings stabilize. But again, we believe that this is going to be a precipitous drop inside of Caterpillar. Next in the docket over here, bringing up Costco. None other than Costco. So why bother with Costco? Same store sales were off. Okay, actually broke Costco. What has been a stock that has just been an absolute, pivotal underlying, has not really been negatively impacted. For instance, last year, take a look, for instance, again, at last year, there's been no negative impact over here, finally actually breaking. Costco, okay, and the break lower with same store sales brings me actually to Walmart. Walmart has been on an incredible run to the upside. I shorted Walmart late in the week, and I want to make this clear. Not only did I short shares, I also used an in-out spread. It's one of the positions when I talk about get your trade on. I opened a new Walmart position. Why did I open a Walmart position? Oh, I got to tell you right now, I love the positioning of this, okay? you're actually seeing Walmart on a rip to the upside when same-store sales inside of none other than Costco were off. It's interesting because there's this big bifurcation right now inside of consumer, staples, discretionary, Target. Target actually has not fared nearly as well as Walmart has. Watch Walmart for the possibility of rolling over. It's also largely predicated on, look, it has had hit of the expected move, hit of the upper edge of the expected move, breach of the expected move, breach of the expected move. That, people, spectacular setup right now for a short position inside of Walmart. I don't wait for things to roll over. I step in and go for the contrarian trade. All right, on from there, Intel. Okay, why am I actually bringing up Intel? So I actually had a bullish position on Intel and exited the bullish position profitably. It does appear to be rolling over. The only question is, would you want to take a short position before the earnings announcement? Look for Intel to actually roll over in this particular instance. Again, after a significant breach of expected move, almost a 3 deviation move, hitting the upper edge of the expected move and pulling in just a little bit. Look for Intel to possibly roll over throughout the course of trade this week. Meta looks opportunistic as well. Why? Okay, this thing has been also just on the bid consistently since they announced job cuts over here. When we bring up auto expected move, okay, it's not doing anything wild right now. It's inside the expected move, but it has been an extraordinary, consistent move to the upside. This is something I actually shorted a couple of weeks ago. We made a few bucks when it dipped down, but it continued to rally. Unfortunately, right now we're butting up against earnings, becomes difficult to take, but watch for Meta to roll over. Again, I think Meta rolling over is a great sign that the S&Ps would be rolling over. Last, but definitely not least in this particular front, I wanted to bring up HYG. Why HYG? Okay, look, there's this huge issue, and I'm going to be talking about this kind of incessantly in coming trade. Huge issue in my mind, junk. Junk right now, if you take a look at the yield, and I know this is small on your screen, so I'm going to write it up here. The yield in junk, okay, is 5.48%. You do realize that the Fed fund futures are trading 475.5. So the Fed is at 475.5. That's basically like, what we term like risk-free interest rate. That's the free money rate is almost 5%. How can junk only be at 5.5%? Look, okay, for a major move in junk when, again, more trade recognizes, junk, it ain't worth, okay, the $75 that people are paying for it. And at least in my opinion, I think this could have a precipitous move to the downside. I'm actually using a risk twist spread. I haven't pulled that one out of the bag in years, people. So when we talk about get your trade on, as always, this week's profits and losses. Look, okay, I closed the 32.25 puts profitably. I closed the 32.75 puts profitably. Profitably means with over a 50% gain. And I closed those. Those are just premium sales. I closed an Intel trade. The Intel trade, by the way, I'm executing much more now inside of Tasty Trade, my activity. Intel trade opened for 74 cents, closed it for $2. Nevertheless, okay, so I had gone out there, closed some puts profitably, closed my Intel trade, opened up Walmart positions I already described. And of course, one of the bigger positions I put on this week is an HYG Risk Twist Spread. What a Risk Twist Spread is, it is looking for, and I'll bring up a 3-year here, a wild and woolly move to the downside. And for those of you kind of interested in what it looks like in terms of a profit and loss graph, there's risk in the trade. It's negligible risk, but there's risk in the trade. But for a break lower, okay, on this risk twist would be huge profitability. Huge profitability over here. And I don't have a lot of contract size on. I have 4 units of this trade. 4 units of this trade, just to give you an idea, if we were to break down like into the 60 region, is between $3,000 and $4,000. And it's plausible. Okay, it's very, very plausible at this particular point to come down to 66 or even lower. Again, in my opinion, the yield in here just does not match like what it should with markets kind of in turmoil over here. So that's get your trade on this week's profits and losses, and of course some new trades that I've put on. Last but definitely not least, as we cover each and every week here on TheoTrade, and the weekend update, we talk about expected move. What's to talk about with last week? Absolutely nothing. So last week we had the $60 expected move, okay? And with the $60 expected move in any given week, when I say $60 expected move, it means we're supposed to move up $60 or down $60. And what did we do? Nothing. I mean, we did literally nothing. We did not hit the upper edge. We did not hit the lower edge of expected move. And before I even give you the new expected move, which is easy enough, I just want to make a quick point that in almost every single week, just look back since the beginning of the year, okay, this one didn't hit. This is a hit. Okay, this is a hit, this is a hit, this is a hit, this is a hit, this is a hit. It just goes on and on and on, okay? So almost every single week, we hit the upper or lower edge of the expected move. I think in the year thus far, there's only 3 or 4 times we have not hit the upper or lower edge of the expected move. Obviously, last week being one of them. We have no consecutive weeks of not hitting an edge of an expected move. That's the important takeaway over here. This next week of trade, so we just came out of a 4-day week. We're going into a 5-day week. In a 5-day week, we have plus or minus approximately $75. Look, you need to be fully prepared, okay, for that break lower or higher by the tune of $75. And again, I say that without hesitation. A lower move, the lower edge of the expected move takes us to about, let's call it 40.29 inside of the SPX. The upper edge over here is roughly 41.80. Now, if we are to head to the upper edge of the expected move, that would also correlate. You're going to love this. If we hit the upper edge of the expected move in the SPX, it absolutely correlates to the 42.11 inside of the S&Ps. So it is a major level. I would not discount the ability for the marketplace to continue to move up, as I said, okay, in no uncertain terms. There's times in this marketplace you got to go up to go down. Sure, the rally may be over. We're going to watch, obviously, tech very, very carefully. But I would say the most pivotal aspect to watch this next week of trade is actually going to be the bond market. The bond market's largely confused. It's all over the place. It's breaking to the upside. It actually sold off here a little bit on a stronger than expected, if you will, jobs number. And I think a lot of people just didn't expect the jobs number to come out anywhere near what was expected. Kind of ironic. Nevertheless, the bonds are largely confused. Those bonds, I believe that confusion is going to wear away. Okay, we're going to come out of that fog of bond war, if you will, this week. And markets are actually going to have some resolution around that. Again, watch bonds very carefully this next week. It's going to be pivotal to the entire S&P 500. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful holiday weekend. Bye-bye.